KVB PRIME, developed for global traders, growing together with you.
Welcome to KVB Prime Weekly Market Commentary. This week, our topic is, after reaching 7-week high, Australian dollar faces pivotal test as energy prices rout. Last week, Australian dollar advanced by 0.39% against US dollar, went up from 0.6388 to 0.6420 due to the coronavirus pandemic. Reserve Bank of Australia adjusts cash rate to new low of 0.5% and slash interest rate by 25 basis points to 0.25% as emergency cut in March. This recent adjustment has resulted in a reduction in the market confidence of the Australian dollar. Thus, Australian dollar plumbed into a 17-year low of 0.5510. In addition, as Australian government has implemented quantitative easing program, its government bond yields went above the US Treasury bond yield, which led to a rebound of Australian dollar from the previous low point. On last Wednesday, Australian dollar reached its 7-week high. Importantly, RBA is due to make new cash rate decision at this Tuesday's meeting, but the market believes that the possibility of changing rates is relatively low. The RBA governor stated that Australian GDP may drop to 10% in June amid COVID-19, while unemployment rate is likely to jump to 10% by the end of this year. However, Australia has been performing better than most countries in fighting against COVID-19. Virus cases remain low. The government is about to weigh out easing the lockdown restrictions, hence the possibility of changing rates cannot be completely ruled out. On the other hand, Australian economic figures were gloomy last week, including the high unemployment rate, the depressed business and consumer confidence. The international rating agency S&P even put Australian AAA credit rating on negative outlook, stating there has been a deterioration in the national finance, and the country faced a deep recession. Although the Australian dollar has rebounded, its prospect is likely to hinge on the future energy prices, because Australia is heavily reliant on exports, and the largest component is natural gas and coal. However, their recent price reduction in the Asian market has weakened the Australian dollar growth. Further, Australia's tourism and educational industry has been severely hit by the border closure during COVID-19 crisis. Oil price crash in late March has also negatively affected movements of Australian dollar. Therefore, Australian dollar may soon become unstable due to the threats from energy prices rout and the future economic uncertainty. Now let's look at the weekly highlight. Last week, US dollar index dropped by 1.18%, Euro advanced by 1.46%, pounds climbed by 1.04%, Australian dollar appreciated by 0.39%, gold price dropped by 1.6%, WTI increased by 4.03%, Bright jumped by 10.6%, Dow Jones and S&P 500 both declined 0.28% and 0.29% respectively. Now let's go into more detail about each assets. US dollar index continued its 4th week of vibration after falling from the recent upper resistance 103. It has been oscillating between the resistance 101 and the support 98.3. The current volatile market is consistent with the pattern of last week, and there are few opportunities for breaking through. The price has been adjusted downwards for 5 days this week, but it has not fallen below the important support level of 98.3. Therefore, this week's trading strategy should pay attention to whether there is an opportunity to break through this shock range. As we said last week, it is obviously that US dollar index is strong globally. Technically, the overall upward trend of US dollar index in the past 2 years will not change, as long as the recent important support level of 98.3 does not fall below. The gradual contractions of this range is what we should focus this week. It is expected to oscillate after breaking out this range and at the same time be prepared for the market trend. Similarly, the outlook of euro after the shock adjustment last week has not changed much, and the average daily price is still within the shock range we analyzed last week. This week will continue to adjust within the fluctuation range of last week's resistance of 1.1150 and support of 1.076. Similar to the US dollar index, the volatility range of the euro is shrinking. It has risen for several reasons. It has risen for several days after last week's intraday closing price support at 1.0760. There is no opportunities for large-scale reversal as long as 1.1150 resistance level has not been breaking recently. Therefore, short selling at a high price is a relatively reasonable operation, especially if the market outlook can break through the support of 1.0820 and 1.0760. Euro will open up more downside. The pound rebounded under the pressure of the above resistance 1.2640 and showed a trend of falling back at the end of last Friday. The 1.2640 resistance positions is clearly very obvious and effective this week. Therefore, this week's trading strategy is to first observe whether the price effectively breaks the upper resistance and the lower support of 1.2360. The upper resistance, which has not been broken through twice, is relatively strong. Only when the price completely breaks the upper resistance, there is an opportunity to buy. However, even if breaks the next resistance of 1.2750 will cause the pound to be blocked. Therefore, in general, there are many resistances above the pound, and the opportunities to participate in long positions are limited. In addition, if the price falls below the support of 1.2360, it will move towards the next support of 1.2160. If the price falls below 1.2360, you can consider short selling. For gold, after hitting a 7-year high record of 1,747, gold quickly adjusted downwards and quickly adjusted upwards again. There are two V-shaped trends at a high level. The shock and the breakthroughs between upper resistance 1,721 and the lower support of 1,661 can provide us a lot to help. You should pay attention to whether it is effectively break through the upper resistance of 1,736 and 1,747 to seek entry opportunities after breaking through the resistance of 1,721. As long as it does not fall below the support level of 1,661 and 1,641, gold will maintain an upward trend generally. For oil price, WTI continued to rebound last week. As we can see from the 4-hour chart, WTI continued to rebound last week. As we can see from the 4-hour chart, WTI is currently oscillating between the upper resistance of 21.2 and the lower support of 17.4. Since the beginning of this year, price has fallen rapidly in the downward channel, and the separation of the upper resistance is very obvious. Currently, the downward trend line and horizontal resistance line are putting pressure on the price to prevent a rebound at 21.2. As we said last week, WTI will basically continue to fluctuate for a while, as long as the price is below 23.4. Overall, in the process of global deflations and slow economic recovery, whether from the perspective of demand for WTI or the inhibitory effects of WTI prices increase on the global economic recovery, there will be no not too many large-scale reversal opportunities for WTI. From the current technical point of view, the upper resistance band of 21.2 and 23.4 still have a relatively obvious inhibitory effect. The direction of WTI market this week has become very interesting. Pay attention to the market's choice for these points and participation opportunities. Thank you.